results, and yeah, the earnings season has just begun.
Yeah, good morning. So, yeah, I think the markets have seen a pretty good rally in the last 2-3 months, not only in India, but also globally. We've seen the S&P and the US markets have breached the earlier peak, and that's where the bigger problem is, right? So I think some of the concerns which were there around whether it was the geopolitical risk, even in the tariffs also, I think there is now some amount of clarity which is remaining. We are seeing some deals being signed through. India should also be able to sign a deal shortly, and most likely it will be probably more favorable than some of the other countries. So I think market, while there is some uncertainty around that, market's not too worried about that. I think the focus will clearly be on the earnings growth, whether we are seeing now that trajectory changing, because for the last 3-4 quarters, we have seen that the earnings growth has been in the kind of a single-digit growth. And when it really turns around and moves on is what the market will be looking for. Though this quarter also, I think, will not be that great. We are expecting around mid-single digit growth. But I think as we progress into the second half of this fiscal year, I think you'll see the earnings momentum start to pick up, primarily because of not only the lower base, but also some of the sectors, which were kind of weak last year or before that. I think you will see a recovery over there. And I think that should, chart the course of the market from here on. For the time being, we see the market being in a narrow range. It's becoming more stock specific now. Clearly, companies where the earnings are surprising positively, where they're getting rewarded, and where they're disappointment, they're also getting punished on the either side. So we are in a zone where I think the macro factors are now kind of underwhelming and not likely to impact. It is going to be the micro factors which will drive the markets from here.
Right, Mahesh, hi, morning. This is Nehi also joining in. You spoke at length about the earnings expectations. Mid-single digit growth is what you're expecting. But where do you believe a little bit of an outperformance on the earnings front we could see in terms of the sectors that could do well? And where do you believe there are some sectors or some themes in the market that could underperform your overall earnings expectation?
Yeah, so if you look at from the underperformance, clearly the larger sectors, right, which are actually pulling it down, which is the sectors like banking, for example, where because of the NIM compression on the rate cuts, clearly I think the growth there will be very muted. IT sector also, we've seen a couple of results come through. There also we are seeing kind of a lower growth over there. And apart from that, I think in the auto sector also we are seeing the growth will be a tad weaker. So there are sectors where clearly the growth will be on the lower than the average growth rate. Sectors where you could see higher growth is one is oil and gas, because last year was a washout year for especially the oil marketing companies. And this year, because of the oil prices have come down, the marketing margins are fairly good. So that will see a big jump. Again, more of a base effect, I would say, and better margins. So oil and gas will see a higher growth. Cement sector is also seeing an improvement after a very bad last year, where the earnings were at its bottom, EBITDA per ton. So that will see a recovery coming through. And then there are telecom sector. Pharma sector should be fairly steady. So these are some of the sectors, which could see an improvement. But others will be more or less middling with the broader average growth rates.
Right, so that's the take on some of the sectors, Mahesh. But last time we interacted with you, you were of the view that the markets have largely priced in all the positives and the negatives at the same time, and that range-bound behavior has continued ever since we last interacted. What do you believe could be the next big trigger for the market? Since you just mentioned that we're still seeing some uncertainty on tariffs, the earnings seem to not be very exciting. What could lead the next leg up in the market?
I think, as I said earlier, the earnings trajectory has to improve, because we are stuck in that zone where overall earnings growth is in the mid to high single digits growth. If you look at the GDP number also, which came in, was while the real GDP was good, but in nominal terms, it's been just around 9.5%. I mean, CPI has also collapsed to around 2.5% or so. So clearly the pricing power is missing. And I think if you are the fact that the impact of the easy monetary policy, the good liquidity which is now there in the system, which is has improved significantly. The monsoons also, right? Good monsoons. So all that, I think, if that leads to an uptick in the overall consumer demand in the second half, I think that will lift a lot of sectors up, and also the pricing power a bit, okay, in across the board, across the consumer as well as the consumer discretionary side. And I think that will be a trigger for the market to really gain back its momentum.
All right, point taken, Mr. Patil. Morning, this is Shrishti also joining in. I just wanted to get more sense within the consumer discretionary basket. Any particular segment within that you are liking at this point in time? Because yes, of course, there has to be a big trigger coming in from those tax cut, the rate cut as well. So maybe autos, retail, within this whole lot of pack, any particular segment that you like at this point in time?
Yeah, so I think in the, the auto sector, probably two-wheelers, okay, could see a better growth in the second half. Okay, that should lift up. A lot of the consumer durable companies are going through a kind of a weak quarter. This quarter, again, some seasonality impact. We have seen early monsoons. So I think as we progress forward, I think you should see that sector pick up. And that's where I think as the transmission of the tax cuts passes through. And then, mind you, we also have the pay commission, right? Which is a kind of every 10-year event. So that would also mean more money at the hands of the PSU employees, which is also equally or most bigger stimulus than the 1 lakh rupees tax cut, what we're seeing in this fiscal year. So I think that trend could continue well into the next fiscal year. And that's where some of the consumer durables, the retail companies could do better. Even building materials has been kind of, still been seeing a weaker growth, but the housing market, okay, where we see new houses being constructed, I think that with a lag impact, that could reflect into the demand for the building materials starting to pick up. So I would say these are some of the areas, okay, where you could see the benefit of the recent tax cuts and the impending pay commission bounty which will come in could benefit these sectors.
That's exactly what I wanted to probe a little bit more, Mahesh, as to why is it that you're overweight right now on building materials, and do you sense that there will be some additional push perhaps that is going to aid the sector in a big way? And again, given that it's such a large umbrella, what segment of construction and the entire housing boom are you most bullish on?
So without getting into the sector, but by and large, as I said, we've seen that in the last couple of years, there has been good new bookings which has happened. And despite that, we've seen the building material sector, the volume growth was not that exciting. Again, that's because of the lag impact. And also post-COVID, we had seen a big kind of increased growth, volume growth in that sector. And that base was also kind of impacting. I think now that is behind us. And as some of these new houses come to completion, okay, you would see that would require growth over there for all these building materials, be it the tile companies or even the paints sector also has seen very, very lackluster growth for the last 1.5 years. So, and again, as the sentiments improve, as the consumer sentiments improve, better disposable income on the back of rate cuts, which is, again, especially the urban side, right? Because that is more sensitive to the rates. I think that should help the whole building material space. One is the low base effect, and then improving sentiment on the consumer side, which can lead to a better volume growth in the coming, possibly in the second half, and then continues that into the next fiscal year.
Okay. Mahesh, last time when we interacted, you did say that assuming there were no downgrades to this earnings season, you said that the markets looked fairly priced. Given the way IT has performed, we have seen some downgrades coming in so far. What picture is that painting for you in terms of the overall valuation in the market? And do you still believe that this earnings season could lead to some further re-rating?
So I think, yeah, there are a few sectors probably which there could be a downgrade, but there are other sectors also probably where there are probably like to report better numbers like oil and gas sector, as I mentioned. So overall, if you look at the headline numbers for the earnings, I don't think we would see, I mean, our expectation is that this fiscal year, you will see around 10% kind of a earnings growth. I don't think that should see much of a downgrade, at least on the headline numbers. There could be some sectors, okay, which could see some disappointments, where others you could see slightly better numbers than expectations. So given that number, I think the market now, if you look at the Nifty or the large cap space, is near the long-term average, probably 3-4% premium to the long-term average, which is not much. And considering the fact that the supply of paper, which is there, the demand which is coming in, okay, from the inflows which are coming into the markets, that is still fairly strong. So I don't think the markets are going to go anything cheaper than the long-term averages. So I think, given the fact that I think market is still fairly priced, I don't see it is feel very expensive. Mid caps, small caps have again rallied, okay, from the bottom of what we saw earlier. So there again, the valuations are starting to look a tad expensive over there. But for the Nifty per se, I would say it is still in the fair zone. And I think earnings growth is what I think you can expect in terms of the returns for the market in the coming period.
All right, but Mr. Patil, I just wanted to zoom out a little and talk about the new trade order that seems to be settling in. Though we are awaiting with the final rate that will get implemented between India and US. But Mr. Patil, of late, we are seeing that China is trying to show their dominance with respect to some of the key sectors that they hold advantage with. Case in point being specialty chemicals, case in point being rare earth magnets. Therein, because of this particular shortage, even India is getting impacted. And back home, a lot of these companies are also now trying to expand their production capacities, try to figure out the new processes. Do you believe that India stands a chance to win in any of these sectors, or the companies can really show their power? Anything that is looking interesting to you which can emerge as a good segment for the Indian players?
Right. I think the China has been trying to come up with its own problems, right, in terms of its own domestic economy not doing well, by trying to export more, right, because that's how they're trying to come out. And they've seen a aggressive production and a more important pricing pressure to drive volumes. At the same time, there's a pushback coming in from a lot of countries because they don't want to be dependent on China completely. And they saw what happened during the COVID crisis. And as a part of trying to diversify the supply chain, I think they are still looking at companies outside China. And that's where Indian companies have an advantage. Obviously, in case of US, the tariff differential, if India gets a better tariff differential, okay, that will put it at a competitive advantage vis-a-vis China and also the other countries over there. So I would say that while it is true that China is trying to dump into the, but other countries are also trying to reduce the exposure on China. That is benefiting likely companies, say, for example, in the textile sector. Okay, clearly there again, I think the tariff differential is to India's advantage compared to other partners, whether it's Bangladesh or Vietnam. In specialty chemical, as you mentioned, also we are seeing now there is a good demand coming in from the European players, okay, which are shutting down their capacity because of high costs, and they don't want to. They already have a big exposure to China, so they're looking outside China. So that's kind of creating opportunity for Indian companies. Again, this is a sector which is again coming back from a very weak kind of growth in the last 1.5 years because of the inventory buildup which was there. But I think we are seeing now again demand starting to pick up on the export front, and the capacities what companies had built up, okay, should start to now deliver over there. I mean, other sectors which are there, rare earths and other areas where I think there is not much of a choice, right? Because China has the large raw material supply base over here, and it will not be easy. So that can disrupt the supply chain, and it could impact a few sectors if that supplies get impacted, especially in the auto and the EV value chain.
Right, interesting. Mahesh, so good having you on the show. Thanks as always for your time.
Thank you.
Okay, let's take a very quick break on that note with news that we're still absolutely quiet when it comes to the index. A lot of individual stocks, of course, Select Pharma and Realty names are the ones which are holding up. We'll discuss all of that when we come back.